Jane Street is being accused of manipulating Bitcoin. A lawsuit claims they had insider information before the Terra collapse. Trading patterns show suspicious selling at 10 a.m. every day. The firm represents 10% of U.S. stock trading volume and 40% of bond trading. And when markets drop, people point fingers at the biggest player in the room. But here's the uncomfortable question. Is Jane Street actually manipulating markets? Or is that just the story that gets told when complex systems behave in ways people don't understand? Because every market crash follows the same pattern. Prices fall, portfolios bleed, and almost immediately, someone gets blamed. It's either manipulation, insider trading, or coordinated selling. Rarely is it just markets doing what markets do: repricing risk, absorbing new information, reacting to conditions that nobody saw coming. If you want to understand how manipulation narratives get constructed and why they spread so easily, subscribe. Because what comes next is going to change how you process financial news when things go wrong. Let's break down what's really happening here. Let's start with the allegations. A lawsuit was filed claiming Jane Street received insider information from Terraform Labs before the Terra collapse. The claim is that this information allowed Jane Street to position themselves ahead of the crash, profiting while retail holders lost billions. On top of that, there are accusations that Bitcoin consistently gets sold down at 10 a.m., suggesting coordinated manipulation. Those are serious claims. Insider trading is illegal. Market manipulation is illegal. If proven, these would be major violations. But let's be clear about something important. Allegations are not proof. A lawsuit being filed does not mean the claims are true. It means someone believes they have enough evidence to bring the case to court. And courts exist precisely because determining truth in complex financial situations is difficult. So what do we actually know? We know Jane Street is a quantitative trading firm. They're a market maker. They provide liquidity across multiple asset classes including stocks, bonds, options, and cryptocurrencies. We know they trade enormous volume, which is why their name comes up frequently when markets move. We know the Terra collapse destroyed billions in value and that many participants, including retail investors and institutions, lost money. And we know that when large losses happen, people look for explanations. What we don't know is whether Jane Street had material non-public information, whether they traded on it illegally, or whether their trading activity constitutes manipulation. Those are legal determinations that require evidence, investigation, and adjudication. They're not conclusions we can draw from headlines or social media posts. This is where understanding what market makers actually do becomes critical. Because a lot of manipulation claims stem from misunderstanding normal market-making activity. Market makers are firms that continuously quote bid and ask prices for assets. They're willing to buy when you want to sell and sell when you want to buy. That service creates liquidity. It makes markets function. Without market makers, trading would be much more difficult, spreads would be wider, and volatility would be higher. But here's the key part. Market makers are not long-term investors betting on one direction. They're managing inventory. When they buy from you, they're now holding an asset they need to sell to someone else. When they sell to you, they're short an asset they need to buy back. Their goal is to stay neutral, capture the spread between bid and ask, and avoid taking large directional risk. That means market makers are constantly buying and selling, large volumes, fast execution, across multiple venues. And because they're neutral, when markets start moving in one direction aggressively, market makers often appear to be on the wrong side of the move. They're selling into rallies because people are buying from them. They're buying into crashes because people are selling to them. From the outside, that can look like manipulation. If Bitcoin is rallying and Jane Street is selling, people think they're suppressing the price. If Bitcoin is crashing and Jane Street is buying, people think they knew it was going lower and front-ran everyone. But both interpretations miss the point. Market makers aren't making directional bets. They're providing the other side of your trade. Now, does that mean market makers never engage in problematic behavior? No. Manipulation can happen. Insider trading can happen. But the accusation that they're always selling at 10 a.m. requires more context. Let's dig into this 10 a.m. selling pattern because it's a perfect example of how correlation gets mistaken for causation. Someone noticed that Bitcoin often experiences selling pressure around 10 a.m. Eastern Time. They looked at the data, found a pattern, and concluded it must be Jane Street manipulating the market. But let's think about what else happens at 10 a.m. Eastern Time. That's when US markets are fully active. It's when European markets are in their afternoon session. It's when institutional trading desks are executing orders accumulated overnight. It's when economic data sometimes gets released. It's when algorithms rebalance based on overnight developments. It's a high-activity time in global markets. If Bitcoin is correlated with other risk assets, and those risk assets are being repriced at 10 a.m. due to broader market dynamics, Bitcoin will move at 10 a.m. too. That's not manipulation. That's correlation. An analyst named Alex Kruger pushed back on the manipulation narrative by pointing out that this selling isn't unique to Bitcoin. It's part of broader risk asset repricing that happens across equities, commodities, and other markets. The 10 a.m. movement isn't Jane Street pressing a sell Bitcoin button. It's the market adjusting to information flow and liquidity patterns that occur at that time every day. This is a critical distinction. Seeing a pattern in time series data does not prove manipulation. It proves correlation. And correlation can have many explanations. The simplest explanation is often the right one. Markets are most active at certain times, and price movements cluster around those times. Does that definitively prove Jane Street isn't manipulating anything? No. But it means the evidence people are pointing to, the 10 a.m. pattern, doesn't actually prove what they think it proves. Now let's talk about the Terra collapse specifically, because this is where the manipulation narrative gets emotionally charged. Terra was an algorithmic stablecoin project that collapsed in spectacular fashion. Billions of dollars evaporated. Retail investors, many of whom were promised high yields, lost everything. The collapse had cascading effects across the crypto market. And naturally, people wanted to know who was responsible. The lawsuit alleges that Jane Street received insider information from Terraform Labs before the collapse, allowing them to exit positions or take advantageous trades. If true, that would be insider trading. It would be illegal and morally wrong. But let's examine what's required for that claim to hold up. First, there would need to be proof that non-public material information was shared. Not speculation, not rumors. Actual communication of information that wasn't available to the public. Second, there would need to be proof that Jane Street traded on that information. Timing that directly correlates with when the information was received. Third, there would need to be proof of intent. That Jane Street knew the information was non-public and material and chose to trade on it anyway. All of those elements are difficult to prove. They require access to communications, trading records, and internal decision-making processes. Courts and regulators have tools to investigate these claims. But social media doesn't. Reddit threads don't. YouTube videos don't. So when accusations spread online, they're often based on circumstantial evidence, not proof. And here's the uncomfortable reality. Even if Jane Street traded profitably around the Terra collapse, that doesn't automatically mean they had insider information. Terra's problems were visible to anyone paying close attention. The algorithmic design had known vulnerabilities. The peg had been tested before. Smart institutional traders could have recognized the risks and positioned accordingly without any inside information. That's not a defense of Jane Street. It's a statement about burden of proof. Profiting from a collapse does not equal causing the collapse or trading illegally. Sometimes firms make good calls. Sometimes they get lucky. Sometimes they're just better at risk management than others. This brings us to a broader pattern. Why do large institutions always get blamed when markets crash? Part of it is size. Jane Street trades enormous volume. When something goes wrong, their name appears in trading data. They're visible. So they become the focal point of blame whether or not they actually did anything wrong. Part of it is complexity. Most people don't understand how quantitative trading works, how market making works, or how liquidity provision works. When they see a firm making money while they're losing money, it feels unfair. It feels rigged. And that feeling turns into accusations. Part of it is narrative simplicity. Complex events are hard to understand. The Terra collapse involved algorithmic design flaws, liquidity spirals, contagion effects, and reflexive feedback loops. That's a lot to process. It's much simpler to say, Jane Street knew and they dumped on everyone. Simple stories spread faster than complex ones. And part of it is emotional. When people lose money, especially large amounts, they need someone to blame. Blaming themselves feels bad. Blaming market dynamics feels abstract. Blaming a specific institution feels concrete. It provides a target for anger and frustration. None of this means manipulation never happens. It does. But it means that in the immediate aftermath of market crashes, the accusations that spread fastest are rarely the most accurate. They're the most emotionally satisfying. Let's talk about how terms like manipulation, insider trading, and short squeeze function in market narratives. Because these words carry weight, they trigger emotional responses, and they get used loosely, often without meeting the technical definitions. Manipulation in legal terms requires intent to deceive or create artificial price movements. It's not just large trades. It's trades designed specifically to mislead other participants. Proving manipulation requires showing that the accused party's actions had no legitimate purpose other than distorting price. That's a high bar. Insider trading requires trading on material non-public information. Material means it would affect a reasonable investor's decision. Non-public means it hasn't been disclosed broadly. And trading means you actually executed based on that information. Again, high bar. Hard to prove without direct evidence. Short squeeze is a technical phenomenon where short sellers are forced to cover positions as price rises, accelerating the upward move. It's not manipulation. It's a consequence of market mechanics. When people use short squeeze to imply that someone is manipulating a stock higher, they're misusing the term. These distinctions matter because they separate real misconduct from normal market dynamics. When everything gets labeled manipulation, the term loses meaning. Real manipulation becomes harder to identify because the baseline assumption is that everything is rigged. This is dangerous. It erodes trust in markets. It creates paranoia. And it prevents people from learning how markets actually work, which leaves them vulnerable to the next crash because they never understood what happened in the last one. So how should you think about allegations like the Jane Street claims? First, separate allegations from proof. A lawsuit is an allegation. It's not a conviction. Treat it as a claim that needs to be evaluated through legal process, not as established fact. Second, understand the mechanics. Learn what market makers do. Learn how liquidity provision works. Learn why trading volume spikes at certain times. The more you understand normal market function, the less often you'll mistake it for manipulation. Third, question timing-based patterns. Just because something happens at the same time every day doesn't mean it's manipulation. It might just be when market activity naturally peaks. Correlation is not causation. Fourth, recognize emotional bias. When you lose money, you're more likely to believe manipulation narratives. That's human. But it's also a cognitive bias that makes you susceptible to false explanations. Check your emotional state before accepting dramatic claims. Fifth, demand evidence. Vague accusations aren't enough. What specific trades? What specific communications? What specific laws were violated? If those details aren't provided, the claim is speculation, not evidence. And finally, accept complexity. Markets are complex systems. Sometimes they crash because of design flaws, cascading liquidations, or sudden risk repricing. Those explanations are less satisfying than villain manipulated everything, but they're usually more accurate. Understanding market manipulation claims critically doesn't mean assuming everything is fine. It means learning to distinguish between real misconduct and narratives constructed from incomplete information. Both exist. Learning to tell them apart is the skill that matters. If this changed how you evaluate market manipulation claims and financial accusations, subscribe. We're here to teach critical thinking about markets, not to promote conspiracy theories or false certainty. Drop a comment if you've noticed how quickly manipulation narratives spread during market crashes. Let's talk about how to separate real concerns from emotional reactions. Because the goal isn't to defend large institutions. It's to think clearly about how markets work, what constitutes actual wrongdoing, and how to avoid being misled by dramatic narratives that fall apart under scrutiny. Markets are complex. Crashes are painful. And the truth is almost always more nuanced than the story that goes viral. Learning to sit with that nuance, to demand evidence, and to question simple explanations is what separates clear thinking from reactive thinking. And in markets, clear thinking is what protects you over time.